not subject to this restriction. They can claim their annual allowance at any time. They don't have any restriction. Now, the maximum amount that is deductible is two-thirds of assessable profit. This makes a company pay tax on the remaining one-third of assessable profit. That means that your capital allowance max that you can claim from the government in any year of assessment is two-thirds of the assessable profit. You can't claim more than that. However, if any company in agro-allied industry or manufacturing can claim the entire amount, there is no there is no restriction. There is no restriction. There is no restriction. That means that if you are in manufacturing and you are in oil and agro-allied industry, you can claim all your capital allowance that year. There are no restrictions. So you could see that capital allowance is very good. You've seen the types of capital allowances that we have, and I'm sure that now you're able to know the importance of your assets, the importance of your asset register. You will know you will value your asset register better. So if your company is not keeping proper asset register, then that becomes an issue. So I will this a company ABC Technology Limited, a client company, but we adjusted the name just so for confidentiality. Okay, but it's a real company that we deal with their taxes. So basically, in doing what we call company's income tax computation, you would have prepared your financials. It could be exported from your accounting system. Maybe you're using Sage, QuickBooks, SAP, Oracle, so many of them, or a bespoke, a specialized account system. You will have pulled your data, you transfer them to Excel, then you do your tax computation from Excel, because most of these software they don't have they're not updated. So the tax law is not incorporated in terms of CIT requirements. It's not incorporated in them. So you use Excel to do the company's income tax computation. Okay, so for a company, you would have gotten the source documents from the bank statements, the schedules, all your schedules from bank statements, schedule, your petty cash schedule, your inventory schedule, your payroll schedule, and fixed asset schedule. Okay, you work on those schedule and you come up with something like this. And if you are in our accounting practice training, at least you would have gone through this session with me, where I prepared all these schedules and preparation of financial statement from source document. So, but I will just summarize how it look like eventually when you've done uh, your FS financial statement. So you have your cover page, you have your table of content for the company, where you write the corporate profile, director's report, report of independent auditor, statement of accounting policy, statement of financial position. After you look at the table of content page, then you need to look at of course, significant accounting policy, statement of financial position, and the likes. Then have your corporate profile. You look at your corporate profile. Of course, you see how it look like. Then you have the report of the directors in your templates. You have the significant accounting policy. This template is actually for another group of people, but I just want to show you in case you are going to consultancy tomorrow and you want to do tax computation. It's a lot of work. It's a lot of work. It's not just from you just pull from Excel. Especially if your client do not have accounting records, you post from the source documents, analyze all their schedule, develop your schedule. This is SOFP. This is the SOFP. That's the statement of financial position. That's it. So see for the same company now. Again, The key thing you need to know is we have the SPOL and we have the cash flow statements. The SPOL is what you need for companies income tax uh, computation. Now in the SOFP, the statement of financial position, you need this for what we call capital allowance computation because PPE is here, property, plant and equipment is here, and you need that for capital allowance computation. And we also have your cash flow statement, the cash flow statement here, just to ensure that you understand the flow of cash from operating activity, investing, and financing activities. Then you have the notes to the financial statements. From note 1 to 2 is incorporated here. The note 1 is operational expenses, note 2 is fixed asset schedules. Then we also have note 3 to 6. Note 3 is bank analysis, admin expenses, marketing expenses, and the final note here is revenue. That's note 6. Okay, because of uh, this is this is revenue for note 6. Quickly put revenue there. So um, basically, I would like to highlight some certain things here in this account so you understand it. For instance, you see your revenue now under note 6. The revenue, the breakdown of the revenue is given here. The breakdown is an IT company. They have these components of their revenue, which is data backup services, about 11.1 million, and net investment income, dividend income received, about 97. This is a breakdown of their revenue. Again, I would like to point out on some components of the admin expenses here. Now, admin expenses under note 4, we are going to see this is the admin expenses, about 2.6 million, 2.67 million. You'll see the breakdown of the admin expenses. Now they have professional expenses here, depreciation here, bank charges, vehicle expenses, meal, fines and penalty by FRS, repair and maintenance, donation to cultural group, utility. Okay, some of these expenses may not be allowed for tax purposes. So that's why the taxman will always ask you, I want to see the breakdown of your COGS, I want to see the breakdown of your marketing, I want to see the breakdown of your admin. I want to see the breakdown of these. All what they are looking for is just to see whether you can they are non-tax, non-deductible expenses. Okay, that's what. So as an accountant, you're able to guide your company better. Okay, so before you do CIT computation, the first thing you need to do is capital allowance computation. Capital allowance computation. That's the first thing you need to do because capital allowance will come. The final outcome of your capital allowance will come when it comes to your CIT computation. So in capital allowance computation, they want to call basis period for capital allowance. And in capital allowance computation for 20, you need to know when they started computing the capital allowance. For instance, if I want to calculate the capital allowance for a company for 2020 accounting year, I need to check the former person, ask for the person calculate the capital allowance. If the company has been existing for 10 years, I need to get the file of the former accountant that have been where they stop. So I'll continue calculating my calculation from there. So that there won't be any discrepancy. So that's why you notice that accounting files are you have to keep them very well. So that you can defend the company. This is what we've claimed so far. This is what we've claimed so far. This is what they're claiming this year. This is what is left that we want to claim. And that's why you see in my schedule that the capital allowance is starting from 2016 instead of showing 2019. Okay, so these are previous capital allowance for this company that we've claimed for them. So we'll be claiming the one for we'll be claiming the one for 2019 year of assessment. This one relevant to us in this training, but we will need to claim it from 2016. So now, for instance, in 2019, The 2019, the basis period, what they call basis period for accessible profit, basis period for capital allowance. The basis period is the period in which you want to claim capital allowance. Now, we have two different kind of basis period. So I've said something now that the Finance Act has simplified our tax computation now. Before it was even more complex than this. But especially when it comes to commencement through, you see different basis period. You have to explain to tax office, your computation, and explain to them basis period that you claimed and the one that you've not claimed. A lot of story, but things are getting easier, and that's good. So what we have now is the basis period for accessible profit is the period in which you are doing your CIT computation. You want to calculate your company's income tax. The basis period for capital allowance is the period in which you are claiming your capital allowance. So in 2019 year of assessment, the business period for accessible profit is 1st of January 2018 to 31st of December 2019. That's the accounting year, which is the same thing as the basis period for capital allowance, 1st of January 2018 to 31st of December 2018. That's the same basis period, okay? So that means the basis period for capital allowance is properly aligned with the basis period for accessible profit, which is good. And it's what we call preceding year basis. Because I showed you 2019 account